I predict we'll have one. I predict we'll have at least one student show up for today's review. Here we go. Who could this be? Oh, hello, Crystal. How you doing? Welcome.
Hi, I'm
Good, good. Looks like you're doing pretty good in the class, huh?
I think so.
Yeah, so far so good. Hey, chapters 4, 5, 6. I can go in. I can go into my review act. Do you have any particular areas you want me to talk about with that, Crystal? I can kind of streamline this your way since you're here.
Yeah, I think I had a little bit of trouble with um the closing process.
Okay.
Um yeah, it took me a couple tries on the homework to kind of get it.
Okay. Yeah, that's chapter 6. The closing process. Do you have anything you want to share with me that I could look at with regarding that? Or
No, I was just looking at my notes.
okay,
Yeah, just I know I highlighted stuff in the closing process.
sure. Okay. Well, let me share something with you then. Hold on. What are we closing, first of all? What accounts do we close?
The revenue and expenses?
Exactly, exactly. We have to bring the net income over to the equity statement. That's why we do the income statement first, huh?
Hmm.
So let me share this, if I may.
Okay.
Okay, you can see the PowerPoint now?
Yes.
Okay, yeah. We close what are called the temporary accounts, and you said it exactly right. The revenues and expenses. The permanent ones are just that, permanent. We don't go in and close cash every month. You know, cash just continues and continues. So the temporary accounts are the revenues, expenses, in other words, the net income and the drawing. They are closed at the end of the month, so that when you go back to the beginning of the next month, you're going to see a zero balance. And the reason for that is we don't want to accumulate the expenses month after month after month. We want to see them in 1 month buckets each month, each period. So let's see what we have here. The closing process, and this is kind of a long-winded thing here, gives temporary accounts zero balances, so they're prepared to accumulate new information for the next accounting period. The income summary is the clearing account, right? That's the account we're going to use to help us in the closing process. And there are 4 basic steps. 1, close the revenue first. Okay, I would make that note. Close the revenue. Revenues have a credit balance. So you're going to debit all of your sales accounts. At that point, those are closed. Then you go to your expenses. Step 2, go to the expenses. You will have to credit every single expense. Credit every single expense and debit the income summary. You with me so far, Crystal?
Yes.
Okay, so when we've done that, when we've done these first 2 steps, we've now put the net profit, the net income, into income summary. Would you agree?
Yes.
Okay, so what is our next step? Our next step is now simply to close that income summary account by hopefully debiting it. Hopefully we made money and it has a credit balance. We're going to debit the income summary account and credit owner's capital. What do you think, Crystal?
I'm with you.
Make a little sense. Okay, I mean that's basically the you're asking about the closing of the accounts. That's what you close. You know what to close, which is the most important thing: revenues and expenses. And now you know why you close them, because we need to move that money over to the capital account. And then you just have to close the drawing, and the drawing has a normal debit balance, so you credit it and then you debit owner's capital, which reduces the owner's capital, okay? Any other questions on closing?
I think it's the actual problems that I have a little bit of trouble with. I think it might be in some of the examples um, where I think in the homework,
Yeah, the
I'm
homework
trying to
can really mess you up.
yeah, it really does sometimes. I think sometimes too the balance, like it was like adjustment and then balance was, I thought balance was displayed under whichever one had wherever there was like oh my gosh, how do I describe this? I thought the balance was under like if we had 500 in the debits and 100 in the credits, then the balance would be 100, but it would be listed under debits, right?
Well, the balance would be 400, not 100.
Oh,
You,
yes, yes.
yeah, balance would, in your example, yeah, it would be a debit balance of $400. Yeah.
And we list that under whichever one, like under the debit or under the credit.
No, you don't have to add up each of the columns. You just add the two columns and take the difference, and that becomes the balance.
Okay.
So
But
I'm
where's the
understanding.
balance usually listed?
The balances are going to come. Okay, that's a great question. The balances are going to come from your general ledger. Your general ledger. During the month, there have been a lot of transactions, huh, Crystal? You've been paying the electric bill, the phone bill, you processed the payroll, you bought things, you paid for things, you sold things, you collected money, you did some special projects the boss made you do. And at the end of the month, you came up with a trial balance. Remember the trial balance? That's simply a listing of all the balances in the general ledger at that time. So the balances come from the general ledger and they're set up nice and neatly for you in the trial balance. So that's where the balances come from.
Okay, thank you.
Okay. All right. What else you got there?
Um,
I'm ready to go into my chapters 4, 5, 6 spiel if you're interested.
yeah, I'm good with that.
Okay. All right. Let me just you today, huh? Crystal, you saved me from a lonely Friday. Okay, what am I looking for here? Come on, come on, come on. Share screen, share screen. You can see the PowerPoint, chapter 4, journalizing.
Yes.
Okay. The reason I asked, Crystal, is that on a few occasions, I went through a whole class not realizing nobody could see the PowerPoints. and I'm pointing to things and I'm looking at not one person said, hey, Bob, what are you doing? There's nothing up there. Okay. So we got the journalizing going, huh? All right. Let me just set this up my way. You ever watch The Big Bang Theory on television? Do you know that television show?
I've heard of it, but I've never watched it.
That's me. I'm the character Sheldon Cooper. I have to set this. Here we go. Journalizing and posting. All right. Now we came out of a chapter where you were introduced to debits and credits, right? Journalizing. Journalizing. This is how the general ledger gets updated. This is where the balances are going to be accumulated through journal entries, okay? And they're talking about source documents. Source documents are just paperwork, okay? On the test, they like to say a cash register tape or an invoice or an example of what? They're source documents. It's a fancy word for paperwork, okay? It could be a text. It could be notes from a phone call. I almost said telex. Oh my God, that takes us back 100 years. Purpose of source documents. I don't think we need to worry about the purpose of source documents. Your general ledger, it's in numeric order, right? Numeric order. It starts with the 100s And it goes to the 200s for liabilities, 300 equity, etc. Revenue, 400, 500 expenses. So it goes in numerical order, starting with assets, liabilities, equity, revenue, expenses, okay? Think of these as a folder. Every one of those is going to be a folder in your general ledger. Now we're introducing you to journalizing. Journalizing. By the way, Crystal, are you good with your debits and credits? I bet you are now.
Yeah.
Okay, hopefully don't have to stumble over that too much. That's a big step in the right direction. Okay. So let's look at a journal entry. Mitchell opened the business with a deposit for 5,000. So let's take a look at a journal entry, or what your book calls a general journal. He invested money in the business, right? So we know cash goes up, and we know that adds to his capital, which was zero. He's just starting the business. So notice that you set up June 1st. June 1st. You see where it says 20 on top of that for the year? You're not going to repeat the 20, I don't think, as you go forward. Just the day and the month, okay? So you have June 1st, cash. Think of the general, think of this. This is like a T account, isn't it? It's a T account, really. So you're going to debit cash and you're going to credit capital. It looks like a T account, but it's really impacting two different accounts. Notice the indentation on the credits. That's very important. Indent. Move it in about 5 clicks on the keyboard, okay? And it's always good to have a little, it's always good to have a little explanation. It can be very simple. To record owner's investment would have been fine. What they put down there is too long, really. Okay. Journalizing. Journalizing. Here are some journal entries. Here are some journal entries, right? Notice what I was saying about the year. The year, you don't really need to repeat that all the time, okay? Covers the whole page. Debit, cash, credit accounts payable. Here's the compound entry they were talking about. Purchased a scooter with down payment. Well, we brought in a scooter, that's delivery equipment, that goes up with the debit. We paid cash, that goes down with a credit, and accounts payable goes up with a credit. Okay? So that's the mechanism, everybody, for putting your information into the general ledger. It's called posting. You're going to sit there, say this is today's work, Crystal. You'll sit there and you'll prepare all these journal entries. At the end of the day, you hit the button that's called post. And that puts everything into the general ledger, okay? Post to the general ledger. Well, that's what we're going to do here. The general ledger, it looks like a T account. It's really a fancy T account. So let's take a look at the general ledger. And you were asking where you get the balances. This is where they're going to ultimately come from. So look at your T account. Got happy fingers. Look at the T account. We have a balance of $470, right? We added up the debits, we added up the credits, and the high man wins. Cash should have a debit balance. If it has a credit balance, there's something wrong. So all the general ledger is taking that T account and presenting it here and adding a second T account for the balance. So you started off with 5,000. That's the balance, 5,000 to begin. Then he spent 2,000 on scooters. The balance went down to 3,000. He spent 600 on something else. The balance is 24. Then he got some, etc. Okay. So the general ledger, pretty comfortable with the general ledger and what it is, Crystal? I think you are.
Yeah.
All right. So now, getting back to your question earlier of where do we get the balances? Well, we're going to take this balance and all the other balances and put them in a trial balance. We're going to put them into a trial balance. And the trial balance is simply a listing of all the accounts and their balances, whether debit or credit. It's not a financial report. It's not a piece of information anybody particularly needs to see except the accounting people putting this stuff together. So take a look at your trial balance. Remember the $470 balance we just had in cash? There it is. And you do the same thing with every one of those general ledger accounts. So that's a little bit on journal entries and how you get these numbers into the general ledger. I'm not going to go over finding and correcting errors. We know we don't make errors. Plus, this stuff is a little too complicated, I think, for something simple. The only one I like is the dividing by 9 trick. I told you that one, right? I told the class, if you write 63 and you meant to write 36, the difference is divisible. 27 in that case would be divisible by 9. That can be very useful once in a while, actually. It's called a transposition error. Look at this. Half this chapter is just on correcting entries. The only real way to correct something, Crystal, is reverse. When you find an error, reverse the original entry. Just write the opposite and then put an explanation to reverse incorrect journal entry number and then put it in correctly. Don't get involved with crossing out. And you just can't do those kinds of things. And that's the end of that chapter. So that chapter's not a real tough one, I don't think. Any questions on chapter 4?
Nope.
Okay. How about chapter 5, huh? Chapter 5. Give me 5 so I know you're alive. Where's chapter 5? Oh, there we go, chapter 5. You never heard that expression, huh?
I have not.
All right, here we go. Now we get into some trickier material, don't we? Adjusting entries. How good are you? How good are you with the adjusting entries? These can be tricky.
Yeah, they are tricky. I think especially when we get into depreciation costs.
That should be the easiest one.
Yeah, I think because I think where I get confused is with the insurance example where it's like the prepaid insurance and then it's not under like a depreciation for insurance, it's like a insurance expense.
Yes. Yeah, you buy an insurance policy, it's for the future, right? You buy an insurance policy in December of 2020. That policy covers you through 2021. So when you bought that policy, it's not an expense because you did not have any insurance in December. If your factory, God forbid, burned down New Year's Eve, you have no insurance. If it burned down, the next day, then you're good. So when you buy that insurance, it's an asset called a prepaid asset or a prepaid expense. And then during the next year, you're going to take that $12,000 and divide it by 12 and divvy it up into $1,000 pieces. And each month you're going to reduce that prepaid account with a credit and debit an expense, debit insurance expense. And let's take a look at them, okay? Prepare end of period adjustments. These are internal entries. All companies do them. All companies, you can't avoid them. And the reason to do them is the recognition principle. We're matching revenues and expenses. We want to get all the revenues that belong in that period, all of the expenses, so we know exactly how much money we made, huh? Revenue recognition principle. Revenue recognition principle. We record revenues when they're incurred, when they're earned, right? Has nothing to do with the cash. Same thing with expenses. They're recognized when they take place. And the matching principle is just that, matching revenues, expenses, fiscal year. Okay, well, let's look at one here. Let me see if I can skip supplies. Okay, let's look at prepaid insurance. First of all, that $200 is a typo. I found out after a while. We still haven't fixed it. They paid $700, okay? Mitch paid $700 for a 10-month policy beginning on June 1st, okay? Beginning June 1st. So at this point, when you bought the policy, you have no insurance. It's an asset. It's good to have, right? An insurance policy, that's an asset for sure. So he debited that asset for 700, not 200. And now that June is over, we need to remove the cost of 1 month's insurance. He was covered starting in June, it looks like. So it was $700. I'm sorry, $700 for a 10-month policy divided by 70. Look at your journal entry. You debit insurance expense and you credit prepaid insurance. You're going to do that for the next 7 months. You're going to write that same journal entry, Crystal. You're going to debit insurance expense and credit the prepaid insurance. And after 7 months, the balance in the prepaid account will be zero. You've used it up over the year, okay? That help a little bit with the insurance?
Yeah, it did.
And it's the same thing with the supplies. Same thing with the supplies. We bought $80 worth of supplies. Well, we haven't used them yet. We bought them in June, but we haven't used them yet. So that's an asset until they're consumed, until they're used. And what they're saying here is at the end of June, there's only $20 worth of supplies left. We're only $20 left. That means we used 60. We used 60. And there is a look at the T accounts. We had 80, and now we adjusted 60 because we used it. We debited supplies expense. And remember, your adjusting journal entries are pretty much going to always be a debit to an expense, huh? Almost always. Debit to an expense, and you're going to credit a prepaid account, or you're going to credit an accrual or accumulated depreciation. Those are the three. Here's the insurance expense laid out for us, okay? We debited, there's our journal entry, debit insurance expense, credit the prepaid. Look at the prepaid account. It's down to $630 in June. July, you're going to do the same thing, et cetera, et cetera. And this expense will build up every month, 70, okay? Don't be scared of the adjusting entries. They're tricky. They just take a little bit of thinking. If you understand why you're doing it, it makes a big difference. We're trying to put the right expense into the right period, okay? Here, you're a working gal, I bet, right? You've had a job, you're out in the workforce, right? You get paid. Here's another typo. That should be 1650, but that's okay. I didn't put these slides together. Not my fault. I can find somebody else to blame. But anyway, they had $1,650 of wages that they already processed as of June 27th, right? In other words, you work for this company and you worked from the first of the month till, say, the 27th, and you got paid for that, okay? Your payday fell on the 27th. So that's done. You don't have to worry about it. But then you then worked on June 28th, 29, and 30, right? You worked on those 3 days and you earned $400. $400. That's money that belongs in the expense for the month of June. Would you agree? Yeah, it belongs in the month of June. So you are going to have to, since we know we're going to be debiting an expense, what is that expense? Well, it's salaries and wages expense. It's wages expense. We're going to debit wages expense. And what account are we going to credit? Do you remember that, Crystal?
Wages payable.
Exactly. Accrued wages payable. Perfect. You got it. Wages payable. you credit that and you debit the expense. So the total expense for the month is $2,750. Assuming you're the whole company, that's how much money that the company owed you for that particular month, okay? Historical cost principle. This is kind of important. I don't know if it'll be on the test too much, if at all, but it's important for understanding the depreciation. When you buy an asset, it's going to stay on your financial statements at its historical cost, whatever you paid for it. If you bought land on the beach in Santa Barbara 100 years ago, your great great grandfather did that, and he paid $10,000 for that land is still only $10,000 on your financial statements, even though it's probably worth 10 million now. Okay, the historical principle. You don't show the gain until you sell the property. So let's talk about depreciation. You said you're having a little trouble with that. Depreciation. It just means we're able to estimate, and it is an estimate, we estimate the wear and tear on our machinery. So let's see what we have going here. We buy a machine for, say, $100,000, 10 years depreciation, that's $10,000 a year. Depreciation, it's a way to match the expenses in the correct month. And we're using, in this book right now, we're using straight line depreciation. Straight line. Keep this side thought in your head. Salvage value. Salvage value. Scrap value, residual value. It's just this. We bought a company car. We bought a $100,000 fancy company SUV for our sales manager, who covers California, Nevada, and Arizona. Well, we paid $100,000 for that car, and we think he's going to drive that car for 5 years, and he's going to beat the heck out of that car. He has to drive all over the desert, and so after 5 years, that car is totally gone. We don't want it anymore. But we think a junkyard will come in and give us $500 for it. That's salvage value. Okay, just a little money we think we can collect when we're done with the asset. So let's take a look here. Now, you interrupt me, Crystal, if you have any questions. This is an area you said you were interested in. Mitch has motor scooters with a useful life of 5 years. That's what you call the life of an asset, the useful life. It's an estimated number. It has to be a reasonable number, though. Okay? And there's no salvage value, which makes it easy, because you never depreciate the salvage value. But let's not worry about that yet. Because the salvage value is zero, the whole $4,800 cost needs to be spread over 5 years. Assume that a full month's depreciation is recognized. Well, here we go. 60 months equals 5 years, right? So $4,800 divided by 60 is $80 per month depreciation. And the reason I say this is the easy one is because that's going to be the same every month. It's always going to be. Did not show us the journal entry. Oh, there it is here. The journal entry is always going to be the same. Debit depreciation expense, debit depreciation expense, credit accumulated depreciation. Okay? Here's another important thing to understand, Crystal. You see where it says delivery equipment, $4,800? You're never going to touch that number. That's going to stay there forever. What's going to happen, though, over the next 5 years, this is going to go from 80 to 160 to 240 for the next 60 months. And when you get done, the accumulated depreciation will equal 4,800. The difference between the original cost of the asset minus the accumulated depreciation is called your net book value. Net book value. Accumulated depreciation, everybody, is a contra asset account. Like all contra accounts, it's married to somebody. In this case, the contra account is married to the delivery of equipment. They go together. They go together to form, God forbid I say this, they get together to form one, in this case, net book value, okay? And here they're just introducing some of the new accounts. Yep, just remember this thing is in, the chart of accounts is in numerical order. It's not in by age or alphabetical or anything. So let's post the adjusting entries. And I think we're good on this part, huh? You know how to post them to the general ledger. Here we go. There's your general ledger. We had $60 worth of supplies expense. I lost my cursor for a moment here. Okay. You debit supplies expense, and that brought the balance up to 60. Here's the prepaid insurance. The prepaid insurance was there it is. The prepaid insurance was 700, and now we reduced it by 70. Okay. Let's look at the next two. Look at your wages. Can you read those numbers, Crystal?
Yeah.
Oh, good, because I can't. Yeah, the wages expense was 400. So that means that's how much we owe you. You bring it over to the general ledger. How come you should be pretty comfortable posting to the general ledger, huh? You get a little stuck.
Yeah, I feel.
Okay, so
no, that one feels.
okay. And look at your depreciation expense. That's the one you wanted to talk about in the first place. Where is my cursor? It comes and goes. Okay, no cursor, I guess. Depreciation expense. The difference between the original cost and the accumulated depreciation net book value. So now we're done with all our journal entries. Now we come to the famous worksheet. Okay, the worksheet. And this is a logical item. Now I'm going to give you a tip on the test. For some reason, I don't know why, they always seem to put in a couple of questions about what's in what column. In other words, they'll say the question is columns, and even I have to think too, like I'm the greatest. Columns 7 and 8 include what? And you have to know that column 7 and 8 is the income statement, okay? So let's look at it. It's not as hard as it sounds because it's very logical, okay? So here is your worksheet. Voila, the worksheet. We start with the trial balance, right? And where did we get all these balances, Crystal? Could you tell me that?
From the general ledger.
Absolutely. Say it like you mean it. Yes, from the you're right. You're good. Yeah, from the general ledger. And then we had adjusting journal entries to write, didn't we? We had adjusting journal entries to write. There are our journal entries, okay? So columns 1 and 2 are the trial balance, columns 3 and 4 is the adjustment. Column 5 and 6, that's going to be the adjusted trial balance. You're going to take every one of these balances from the trial balance and bring them over in an adjusted form, right? You have no adjustment for cash or accounts receivable, so you would just bring that balance over. Supplies were 80, you use 60, the balance is going to be 20. So here they're adding the next pair of columns. Zoom in. Okay. The next set of columns. 470, no adjustment. 3,100, no adjustment. But look at the supplies, the prepaid supplies. They went from 80, we used 60, $20. Prepaid insurance, we had a debit of 700, credit here. That brings it down to 63, $630. What do you think on this process so far, Crystal?
Yeah, the worksheet was pretty intuitive for me.
Good, good, good. We like to hear that. That's a good word, intuitive. Yeah, and it is. It really is. It's logical because you're starting with point A. They're giving you the changes, and then you come to the new point B. Okay. So of course, we are going down and we're adding the balances, making sure they equal, right? Now we're up to 7 and 8, the income statement. The income statement. Take a look at the income statement. Like I said many times, everything below capital is your income statement. Everything above is the balance sheet, right? Little tip there. So look, we go over to the income statement and we bring over the $8,000 in revenue and we debit all of the expenses. But we don't balance. Oh, we don't balance. Well, that's good. We don't want to balance this column. How come? Because we want to see a whole bunch on the credit side. We want to see a lot of sales exceeding expenses. So therefore, the difference between the two is 4,640. So that's going to show as a debit on the income statement, and then it'll be a credit when we come over to the balance sheet. In other words, we're going to be out of balance by the same amount in columns 7 and 8 as we will be in 9 and 10 if we did things correctly. Okay.
I think I got confused on this part. And I think on one of the quiz, because I think on one of the quizzes it asked what does the net income appear as a debit or credit on the income statement, and I thought it was a credit automatically, and so I think it was a little confusing, but then I understood it's because they both end up adding up to balance out.
You were wrong, as we say. Yeah, that's probably not a real good question to put on a test, really. I would not put that question on there. But yeah, on the worksheet, it's presented as a debit because you have to get the debits up to equal the credits. And therefore, when you come over here, it'll be on the other side. So, and then let's look at the balance sheet. We bring all the balances over, 470, 3,100, the new balances. Don't make the mistake a lot of people make. And if I'm going too fast, I might do the same thing. You go in here, 470, 3,100, and then you end up going back here and using those numbers instead of the adjusted ones. Okay. So Crystal, if you have a pretty good comfort level with the worksheet, that's a good step in the right direction. Okay. Wow, more on finding errors. Well, we still have to write the journal entries, don't forget. So let's see what we have here. Allow me to zoom with the beat of my heart. Okay. Trial balance. The trial balance. The worksheet. Oh, I see what they're doing there. I was getting ahead of myself. They're just pointing out that you actually have to write the journal entries. Putting them on this sheet doesn't cut any ice. You have to write the journal entries. We're not going to talk about cash, modified, or otherwise. We're not going to do it. We refuse to do it. And that's pretty much the end of chapter 5. So we went through we started with chapter 6 and we went through chapter 4 and 5. What do you think? Is that enough of a review for you? Or anything else you want to talk about?
No, I think I'm good.
Okay.
I just had those questions on there.
You think we helped the rest of the class?
I think so.
I hope so, right? Yeah, where is everybody? Poor Crystal's my only audience here. I'm bouncing every idea off her, okay? All right, well, with that in mind, we'll consider this our conclusion to the chapter 456 review. Good luck, everybody, including you, Crystal. And I'll be looking forward to looking at your grades in a couple of days, okay?
Sounds good. Thank you.
Okay, bye-bye.